What you need to know before investing in the stock market in 2023. I'm sure you know that 2022 was a bumpy year for most people's favorite investment asset class, stocks. At the start of the year, one of the more famous indices, the S&P 500, was at an all-time high, approaching the 5,000 level, before losing massive value and causing just about everyone's 401k to be worth anywhere between 20% and 40% less, depending on who you ask. Add on to that the economic uncertainty, first caused by interest rates being so low, which caused inflation, which is leading to interest rates going higher to solve inflation, which has a ton of ramifications on economics and thus the health of the companies that make up the stock market. It's just going to be tough to know what to do with all this information swirling around. That's where I come in, helping to put together the various cords of information out there to make a melodious and harmonious investment year in 2023. You're welcome. So be sure to like, subscribe, and click the notification bell if you need more videos just like this one. And before we get any further into it, I'm Derek West. You're watching Finance Squared, the best channel on YouTube for understanding the basics of how to increase your personal finances. In any case, before we jump into the world of investing, it's important to understand three things. The first thing you need to understand is the basic economic environment. What do I mean by that? Well, basically you have to understand and get a good grasp of the current market trends, and even more than that, what the overall macroeconomic fundamentals are. Secondly, you need to understand what those fundamentals mean to the companies that make up the stock market. Finally, you need to understand what to do once the understanding is there for the basics of the economic environment and what it means for the fundamentals of the companies that make up the market that you're interested in investing in. Again, applying certain principles to either overcome those fundamentals or ride the wave. Now, investing in the stock market can be a great way to generate returns and grow your money. That said, as I'm sure you all know, and as evidenced by the last year, it also carries some risk. Let's go over how the economics of inflation will affect your investments in the year 2023. The macroeconomic situation that underpins the companies that make up the stock market, well, that's a key component to understand, particularly when trying to grasp what is the right move when investing and what is the right move for investing in 2023. And as I'm sure you're aware, after effects of virus mitigation strategy, we all know which virus I'm talking about, but low interest rates, among other things. All of those factors contributed to inflation getting to uncomfortably high levels during the last couple of years. And everyone's favorite economic phenomenon, well, it causes pain in several ways. But the most obvious is that it causes prices to rise faster than people's ability to pay them. Inflation typically starts with commodities getting more expensive. We saw that with the prices of lumber, oil, etc. going through the roof. This causes the products that are made out of these commodities to also go higher, eventually reaching the customer. The problem is that the customer is typically not in a position to pay those prices immediately, generally because they already agreed to the salary at the job they're currently working and can't get an immediate raise, or can't get it within the time frame that the prices are rising outside of their comfort levels. And even when they do get a raise, that increase might not cover the rise in prices that they're experiencing. This causes those same customers to make rational economic decisions to cut back on or delay spending that they would normally engage in to prioritize necessity. Multiply that by the millions of people in an economy, and you start to see slowdowns in the revenues of companies that provide goods and services to people, typically starting at non-essential products. We're lucky to live in a society that recognizes that is a negative trend that, if not reversed, could cause massive economic damage. There are societies out there that do not know or don't care about that and continue to do what they were doing previously. But the cure to what ails an inflation-ravaged economy can be pretty serious pain in the short term. Think about it as the party is over and everybody is sobering up. I mean, you had a good time when the drinks were flowing, right? But you started to slur your speech and you can't stand up straight. Not only that, you have to be at work in the morning to afford to do this again sometime soon. So basically, you need to sober up. Cut off the drinks, maybe get some coffee, but also brace for the massive hangover that is coming. But once all that is over, you should be in a rational state of mind to kill it at work or your side hustle and make enough money to party like crazy next time. The parallel here is that the drinks stopping is the printing presses at the Federal Reserve slowing down or stopping the money printing and curing everything by raising rates. That has implications. What are those implications? Interest rates need to be raised in an economy when there is general inflation, or prices in general rise for many companies, not just companies, but consumers especially. And those rates and prices rise faster than their ability to pay them in the short term. And that has meaning for companies. And those companies that make up the stock market will affect how your investing will go in 2023. Raised rates mean that banks will be more strict when lending money. Generally speaking, that means that there will be less capital floating around in the economy. People will not be able to get loans for their homes or cars or, vacations as easily. Companies will not be able to raise as much capital to expand their operations. and startups won't be able to raise cash to fund their operations. If those same companies are issuing stocks on stock markets, investors looking at those balance sheets and revenue statements will begin to say, well, it might not be worth it to own a stock in this company right now, which means that the value of those stocks will fall for the same reason that inflation was raging in the first place, by the way. That is to say that the fewer people value an item, the less valuable it is in general. Stocks will generally plummet and specific sectors will be hit pretty hard. There will also be sectors that fare pretty well, which is the key to investing well during times of high interest rates. There are various technical reasons for certain stocks getting hit harder than others that are beyond the scope of this video. But in general, during high interest rate environments, market sectors such as real estate, medical equipment, software, think startups, and companies related to mining certain commodities such as gold, they all get hit relatively worse than other sectors of the general stock market. There are reasons for all of these. When interest rates rise, people are less likely to invest in real estate, either as a primary residence or to invest in real estate in general. Same thing with real estate construction. Similar for startups, since quite a few startups that are already on the stock market are typically years away from seeing a profit and are seen as growth stocks. They are more reliant on investors to fund their operation. And this is because when interest rates go higher, money is tighter in general. Investors become impatient with this lack of profit and they seek to move their money to stocks that are more value plays. And what are these value plays? There are a number of market sectors that tend to do pretty well during environments where the interest rates are higher. These include financial institutions, consumer staples, transportation, leisure, and entertainment. Financial institutions benefit typically because rising interest rates can mean that the people that can borrow can afford to pay off their obligation, and therefore there are fewer non-performing assets on balance sheets of companies. So think of banks and insurance companies, as well as brokers such as Charles Schwab, TD Ameritrade, etc. Consumer staples, they also tend to do well since people tend to focus on their priorities during a tough time. Paradoxically, leisure and entertainment can also do well in high interest rate environments, as people tend to want to escape to a time when things were just doing all right. But now you know how the overall economic environment affects the companies that make up the stock market. The key is what to do with this information. What are the 3 different investment strategies for investing in the stock market when interest rates are high? There are generally 3 different investment strategies when trying to invest in the stock market during high interest rate environments. There are basically 2 prominent schools of thought on how to invest when interest rates are high. The first being to go defensive and invest in safe havens. We mentioned consumer staples and healthcare, but there are precious metal commodities and ETFs that people often flock to as well. The second prominent school of thought is to dive into investing in financials and other sectors that tend to do well during rising interest rate environments. The first strategy of being defensive, typically for folks that are more conservative in their investment strategy, and their thinking is that during high interest rate environments, the economy in general will contract, and therefore it's best to be defensive. The second school of thought is for folks that are more aggressive in their investment strategy, and their feeling is that even during times when the stock market in general is lower during high interest rate environments, it's best to dollar cost average your investments and get into stocks when they are lower. And they're both legitimate ways to protect and even expand your nest egg. But there's also a third, less discussed, but often more prudent school of thought on what to do during tough interest rate environment. Nothing. Particularly if you're investing in broad market sector ETFs or index funds like the S&P 500 or the Russell 2000. The reason being, those indexes follow the general trend of the market, and that trend has been up for most of its history. Simply leaving your investments alone will result in you winning the investment game. Ironically, doing nothing might be the hardest plan to stick to. When everything is seemingly failing all around you, the temptation to just change something up can, for many people, be more than they can handle. But if you're invested in more than just broad sector ETFs, that might not be an option for you. Either protecting what you have by moving your investment dollars into consumer staples, precious metals, bonds, etc., or by investing in financials. Those are pretty good strategies that you can deploy. One of the most important things to keep in mind when investing is the importance of diversification. A great question to ask yourself is, should you be investing in stocks when interest rates are going higher? There is a school of thought out there that instead of investing in stocks, you should be investing in bonds if interest rates are going higher and the economy in general is doing badly. And that's why diversification is so important. Diversification will help you reduce the risk of losing all of your money in a single investment by not putting all of your eggs in one basket. Something to keep in mind as well, there is no single stock that will always perform well, or even a basket of stocks that will always perform well. There will be times when most stocks do well. We just experienced some of those times. But there also will be times when they perform poorly. We've just experienced that even more recently, which is again why it's important to diversify your portfolio to reduce risk. You should mix your stocks and your funds into various asset classes to create a strong portfolio that perform well regardless of the conditions in the market. And even beyond that, you should expand beyond stocks to things like real estate. But just keeping in mind that diversifying your portfolio gives you the best chance of increasing your wealth in the long term. As you know, there are various strategies you can use to diversify your portfolio. One strategy is to buy different types of stocks in a single industry, again, helping you to balance out your risk. Another strategy is to invest in different regions, USA, South Korea, Japan, Europe, etc. And ideally, you should have a diversified portfolio that has stocks from different regions and industries, or just buy broad market ETFs and index funds. And as always, understand the risk when investing in the stock market, whether it's 2023, 2022, 2025, etc. No investment is completely risk-free, and stocks are no exception. Before you invest, you have to understand the potential for losses and how a loss could affect you. And keeping in mind that investing in the stock market is not foolproof, and the risk is actually relatively high compared to simply saving your money. But with that risk comes a reward of earning more than the rate of inflation. Even despite this poor year, the S&P 500 has a history of gaining 8% annually year over year, when averaged out over the last, I believe it's 80-year period. So if you're investing in S&P 500 index funds and the price drops in the short term, this means that your investment will lose money in the short term. But if you stay the course and the S&P 500 performs similar to how it's performed in the recent past, you should be just fine. So let us know in the comments down below what you think about how to invest in stocks in 2023. Do you have a particular strategy that you feel you're going to execute for 2023? Are you going to hunker down and just buy bonds, consumer staples? Are you going to be adventurous and buy financials and other asset classes that typically perform well during high interest rate periods? Do you have another strategy? Let us know in the comments down below. And remember to like, subscribe, click the notification bell if you need more videos just like this one. And remember, a goal without a plan is a wish. A goal with a plan and no action is a wish list. I'll catch you guys in the next video. Take it easy.